I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 0809. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well. So on Tesla, the end demand is the end demand. And in Shanghai, it does appear perhaps that high end demand is giving way to a little bit of low end from a pricing point of view demand because of the economy there. Yet in thinking about Tesla's positioning, now that supply chains have loosened up, I believe what's going to happen is Tesla is going to be at the forefront of being able to drive down costs and prices so that this idea of electric vehicles moving into the mass market is going to start to take root. Tesla is very aggressive at cutting costs and prices once we get out of this situation. So no, I'm not worried. In terms of manufacturing, which is the gating factor here, we need new plants as EV scale, we believe, from 8.5 million units globally this year to perhaps 60 million in 2027. We think Tesla is going to be at the forefront of that. And so our conviction there has not diminished. Elon's main role at Tesla right now is moving it towards an autonomous taxi platform, which we think will happen in 2024. I think he thinks it'll happen next year. I think he is as focused as ever on that. And yes, he has had his hands full with Twitter. I think he's surrounding himself by the right engineers, and he's going to bring in new leadership. I notice, I don't know if this is going to be the case, but Brett Taylor, who just left Salesforce.com, was on the board of Twitter. and certainly understands that company. He's an incredible operator. It'd be interesting to see him come in. I don't know if that's going to be the case at all, but I know he's going to surround himself by the right business leaders. He's not going to be running that company on a day-to-day. When I saw him step down, now there are others stepping down as well, so maybe there's just an outright restructuring going on there. But I thought, he was on the Twitter board. Maybe, you never know. This is not even a rumor. I'm just saying he's the kind of person that I believe Elon Musk is attracted to and will surround himself at Twitter.
If you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is sort of, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. So we've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world. And especially in the United States, it looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling. Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because Either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.